Hello, welcome to Any Answers Answered for June 2021. Tim and I have had a look through the pages of Any Answers on AccountingWEB and found a couple of questions that we would like to discuss. The first of them relates to a topic that's been talked about throughout the profession. It features in this month's Tax TV, in lectures as well, and it is the extended loss carryback for corporates that Rishi Sunak announced in March. And Tim, when it comes to this topic, a lot of people getting confused about the application of it. And we have a question from VP who would like to ask you this. They have a trading loss for the year ended 31st Jan 21. They're carrying it back to 31st Jan 18. As they explain, this is the only year where there are profits to offset under these new rules. Do I need to amend the 2018 corporation tax return, or is ticking box 45 on the 21 return okay? Box 45, of course, is the claim or relief affecting an earlier period. VP says they can't find the answer. So do you have the answer?
Well, I do, and so indeed does VP, because just a few days ago, VP posted an update to his or her or their original posting, and that referenced the revenues agent update 84 and gave a link for AccountingWEB members that would like to have a look at this, to an article in which HMRC set out the rules for carrying back a loss for a company under the new Finance Bill 2021 extended carryback rule. And a couple of points that are included in that agent update and which are referenced in the latest replies to this posting. The Finance Bill has not yet had royal assent. It will probably get royal assent in about mid-July. And that means that nobody can take advantage of the extended loss carryback rule until after royal assent. But once royal assent is in place, it will be possible for a company to submit to HMRC a carryback not just to the immediately preceding accounting period, but to the 2 years before that. Now, the original posting that VP put onto AccountingWEB describes a trading loss for the year ended 31st of Jan 21. And that year has, of course, ended. They want to carry it back to the year ended 31st of Jan 2018. The first point is that ordinarily, you've got to wait until the accounting period has ended and then make a loss carryback claim in the CT 600. And you don't amend the earlier return. You're out of time anyway for amending earlier returns in respect of this carryback. So the amendment issue doesn't come into play. What you do is complete the CT 600, and that will then generate a freestanding credit to the company's tax account. But if the loss itself is less than the de minimis figure provided for in the Finance Bill of £200,000, then you don't have to wait until the CT 600 is filed. You could make an out of return claim. So the fundamental question is, do we do it within or out with a return? Ordinarily, you would have to do it within a return, although last August 2020, the Revenue published concessionary treatment for 1 year carryback. And I think we can assume that would extend to 3 year carryback now. But that concessionary treatment can't be invoked for the additional 2 years until after the Finance Bill receives royal assent. And in any event, because of that de minimis 200,000, could only be invoked for the additional 2 years if the loss that we're carrying back the additional 2 years does not itself exceed 200,000. So an interesting question posed in early May and then answered largely by the original poster of the question towards the end of May.
Well, a hugely important area, particularly obviously after the last 12 months where many people have had absolute disasters with their corporation tax losses. Our second question this month is an administrative question actually, but I think it raises some interesting points. It comes from James DS, and the question is as follows, to do with RTI information. They are bringing their payroll in-house for the first time in 20 years, and currently setting the software up for the first monthly run-through of auto-enrollment. We pay both employee and employer pension contributions, and the employee pension contributions obviously on the payslip, so that clearly information going with RTI. But the question is there also an obligation to report employer pension contributions? And if yes, how is this done?
Well, happily, the answer is no. To the question, is there an obligation to report employer pension contributions? And given that that answer is no, the second question, if yes, how is this done, falls away. But amongst the 16 comments or replies to this posting to date, a number of points are made about how different payroll software providers deal with this. But the consensus that emerges is the correct one, which is that these employer pension contributions do not have to be reported to HMRC. There is discussion about the difference between pension contributions going into DC or direct contribution schemes and those going into DB or defined benefit schemes. But a key point that I think needs to be made and that hasn't been made amongst any of the comments that I've seen to date is that it might be that the amount of employer pension contributions has to be taken into account in determining whether the employee's annual allowance for pension contributions is exceeded. Now, for the vast majority of employees within auto-enrollment, this will not be an issue because the employee's total pension contributions, or to give it its technical term, pension input amounts, will not get anywhere near the 40,000 a year annual allowance. But for some, in particular for director shareholders, the possibility is that they are getting close to or even exceeding their annual allowance by a combination of company pension schemes and self-invested personal pension contributions and so on. And in order to determine whether or not there is an excess charge on the excess over the annual allowance, you do need to find out what the employer pension contributions are. And this complete lack of requirement to report employer pension contributions to HMRC could make that a bit more difficult. Now, the poster is talking about auto-enrollment employer pension contributions, but the same point applies where we're looking at employer pension contributions directly into, let's say, a director's own pension scheme. So if a client company is advised, quite possibly by an independent financial advisor, nothing to do with the company's accountant, but if an IFA says, oh, did you know you could pay 40 grand into the director's SIP and the company gets corporation tax relief on that, but there's no tax or NI charge on the director, well, they might be right. Unfortunately, there's no requirement to report that employer pension contribution to HMRC, but you do need, as tax agent advising on tax, to identify such contributions, because it could be that that director shareholder doesn't have a 40,000 annual allowance. It may be tapered down because of they've got very high income, or it may be that they've got other pension contributions outside the company. So this lack of an obligation to report employer pension contributions can actually cause difficulty where we're not aware that individuals are breaching the annual allowance limit.
So again, an administrative question that actually leads to a number of conversations about things that we have to consider in terms of pensions and employee contributions, employer contributions as well. Hopefully useful to both people who asked those questions and also everybody else. We look forward to seeing you next time on Any Answers Answered. But for today, see you soon.